This one's a bit of a conundrum to me. When the stock market started to reel from coronavirus fears, commodity markets, with the exception of the precious metals, which I'll leave aside, tended to move with the stock market. The theory being that if you if this virus, the more the virus becomes prevalent in China, the harder it is for them to maintain their economy, to maintain their levels of consumption, to maintain their levels of production, and that will have ripple effects throughout the economy. Stocks reflected that. The supply chains are very global now, and there are companies that are already seeing their supply chains affected that are causing them to cut output in their home countries because of a shortage of parts from China. And just the general feeling that if the economy starts to reel a bit in China, that's going to depress the demand for oil. It's going to depress the demand for copper and other items of that nature, industrial commodities. What we started to see this week was stocks start to move higher without really bringing commodities along with it. When I'm taping this now, we'd seen the stock market rally sharply in the first 2 days of the week, only to see oil flirting with the $50 level, which is the low end of a trading range that's gone back for some time now. Copper has had a series of down days. It's had a couple of bounces here and there, but for the most part, Dr. Copper is telling you not all is not well with the economy. I attribute it to one of two things: the divergence. I think that we have FOMO again in the stock market. A couple of good days get people back on the horse and not wanting to miss any sort of rally. Remember also, I've said this before in previous videos, markets react differently depending on where the trend is. The short-term trend in the stock markets has been flat to down. The longer-term trend remains higher. The S&Ps, for example, bounced more or less off their solidly uptrending 50-day moving average and have since bounced higher from there. So I think you're seeing a lot of technical trading, continued money flowing into the stock market, and just this general sense among investors that we've been good for so long. Buy the dips works. And as I've said, it does tend to work when you have an upward trending market. And there is one caveat, though. When you start to see excessive volatility often occurs at tops and bottoms, turning points. It's too early to say if we've hit a major turning point for the market. Another thing to say is when the markets do have a bearish tone, bear market rallies are sharp, short, and painful. But it's really too early to know whether we're forming a top, whether we're in a bear market. In the short term, the trends have tended to point higher. We've seen people buy the dip. They're doing it with such a ferocious desire for shares, at least the first couple of trading days of the month, that it's giving at least the illusion that things are all back to normal. But I would keep my eyes on the commodities. If they don't confirm the positive economic story that the stock market seems to be reacting to, that might be a tell for future gyrations ahead.